Welcome back to the Deep Dive. So today we are looking at a corporate strategy that is, honestly, it's a little terrifying to watch unfold in real time.
Yeah, terrifying is probably the right word for it.
Right. Because usually, when a massive global company releases a financial report, the whole game is to spin the bad news.
Oh, absolutely. The standard corporate playbook is deny, deflect, distract.
Exactly. You blame the weather, you blame currency fluctuations, you talk about,
Macroeconomic headwinds.
yes, macroeconomic headwinds, always the headwinds. But today, we're diving into PMA's full-year results for 2025, and they aren't spinning the disaster at all.
No, they are leaning right into it.
They really are. I mean, for you listening, we are talking about a company that deliberately decided to slash its own sales, report a net loss of over €500 million, and then basically tell their shareholders, hey, sorry, you get zero dividend this year.
It is stark. Really stark. But the fascinating part is that what we're looking at isn't an accident. It is arguably one of the most aggressive, high-stakes examples of a strategic reset in modern retail history. PMA's CEO, Arthur Holt, is actually calling 2025 the reset, 2026 the transition, and then 2027 is supposed to be the comeback.
So it's like a three-act drama.
Precisely.
But before we get to the whole comeback part, we really have to look at the wreckage of Act 1, which is 2025. I've got the financial release right here, and the numbers are red.
Very red.
Just incredibly red. And our mission for this deep dive is to really figure out why a giant global brand like PMA would intentionally shrink itself. Like, is this genius brand management, or is it just corporate suicide?
Well, let's start with the damage report. Let's look at just how bad 2025 was.
Okay, lay it on us.
It was ugly by design. If you look at the top line, the sales, they declined 8.1% on a currency-adjusted basis.
So that means even ignoring the fluctuating value of the euro or the US dollar, they just sold significantly less stuff.
Exactly. But if you look at the reported numbers, which includes the currency hits from volatile markets like the Argentine peso or the Turkish lira.
Oh, right. Those have been all over the place.
Yeah, they have. So factoring those in, reported sales dropped over 13%. They landed at about 7.3 billion euros for the year.
Okay, so a 13% drop is bad. But the profit line is what actually made me do a double take when I was reading the sources.
The bottom line.
Yeah, because in 2024, they made a decent profit, right? About 281 million euros.
Yeah.
But in 2025...
a net loss of 645.5 million euros.
See, that's nearly €1 billion swing in the wrong direction in just 12 months.
Yeah.
If I'm an investor holding that stock, I'm panicking.
You might be. But you really have to view this as a deliberate surgical operation, a very expensive, very painful surgery without anesthesia.
Okay.
Arthur Holt was explicit in the report. He said, and I quote, "It is crucial to make the PMA brand less commercial."
Less commercial. See, that phrase trips me up every time.
How so?
Because usually businesses exist to be commercial, right?
Yeah.
You want to sell as much product as possible to as many people as possible. Why on earth would a major brand actively want to be less commercial?
Because in the world of brand heat, in the fashion and sneaker world, ubiquity is the enemy.
Ubiquity, meaning being everywhere all at once.
Exactly. Commercial here is basically a polite corporate way of saying mass market. It means selling your sneakers in generic discount bins or in giant warehouse stores where they just sit next to no-name brands.
Which kills the cool factor.
It completely kills it. If everyone can get your shoe for cheap at any random outlet, nobody aspires to wear it anymore.
Ah, okay. So it's the difference between being a brand that people actively hunt for versus a brand people just settle for because, well, it happens to be on sale.
Precisely. And P&M management felt they were becoming the brand people just settled for. So think of this strategy like an overgrown rose bush.
Okay, I like a good analogy.
It's huge, right? It's taken up the entire garden. It looks massive, but the actual flowers it produces are small and weak.
Right?
So PMA basically took a pair of heavy-duty hedge clippers and hacked the whole thing back to the stumps.
And in this scenario, those stumps are the distribution channels.
Correct. The financial report talks a lot about cleaning up distribution. In plain English, they called up the retailers they felt were damaging their brand.
The mass merchants.
Yeah, especially in the U.S. They called them up and just cut them off.
That is such a bold conversation to have. Just, hi, we know you sell millions of dollars of our shoes, but you make us look deeply uncool, so we're done doing business with you.
It is incredibly risky. But they actually went even further than just stopping new shipments.
What do you mean?
They didn't just stop sending new shoes. They executed what they call inventory takebacks.
Takebacks. Define that for us because it sounds like a return.
It essentially is a return, but on a massive corporate scale. PMA went to these retailers who had old stock just sitting on their shelf, stock that was probably about to be heavily discounted just to get rid of it.
Because it wasn't moving.
Right. And PMA said, give it back. We will literally buy it back from you. They've physically removed their own product from the market to prevent the flood of cheap Puma gear from hitting the streets.
Oh, wow. So that explains why the revenue tanked so aggressively. You aren't just failing to sell new stuff. You are effectively refunding past sales.
Exactly. And simultaneously, they stopped their own promotional activities. They stopped the heavy discounting on their own direct websites.
Right.
So when you stop discounting and you stop selling to the mass discounters, your revenue just falls off a cliff.
But the theory is that the product that does remain out there in the market is sold at full price.
Yes, to maintain that premium status.
It really sounds like they just ripped the Band-Aid right off, specifically in the fourth quarter.
Oh, Q4 was an absolute bloodbath. That is where the strategy really accelerated. Overall sales dropped nearly 21% in just those 3 months.
Wow.
And if you look at just the wholesale business selling to other stores, it cratered by almost 28%.
That's a quarter of their wholesale business just gone.
Gone. That is the direct result of firing those mass market partners.
But wait, you can't just torch your wholesale channel without a backup plan? Did they shift those customers somewhere else?
That is actually the green shoot in the data. It's the one truly hopeful metric in the report. While wholesale collapsed, their direct-to-consumer business, their DTC, held up much better relative to the mix.
Direct-to-consumer, meaning sales through their own website and their own physical PUMA stores.
Exactly. The DTC share of their business increased to over 41% in the fourth quarter. That's up from about 35% the year before.
Okay, so there is the pivot. They are selling fewer shoes overall, but they are selling a much larger percentage of them directly to the customer without a middleman taking a massive cut.
And more importantly, they are controlling the price. They're controlling the customer data. It is a much healthier way to do business, even if the total volume is significantly lower.
That makes sense.
They also mentioned in the report that despite taking back all that inventory from the retailers we just talked about, their total inventory levels only rose by about 2%. They actually claim the cleanup is slightly ahead of plan.
Wait, how did they manage that? If they took back millions of shoes from the U.S. market, shouldn't their warehouses just be bursting at the seams right now?
They turned off the tap from the factories. They drastically decreased their purchase volumes from their manufacturers. So they were draining the swamp of old supply while simultaneously stopping the flow of new supply. It's an extreme form of inventory management.
Okay, let's talk about the actual product for a second. Because if you cut off the cheap mass market stuff, you're only left with the premium stuff. Is anyone actually buying the premium gear? Or is the brand just totally cold?
The report breaks this down into winners and losers. And I have to say, the losers list is long and painful.
Lay it on me.
Footwear was down 25.4% in Q4. Apparel was down 13.7%. Accessories down over 18%. They even specifically called out softness in golf.
For softness in golf, golf is usually the steady eddy of sports retail. If golf is down, things are tough overall. But footwear being down 25%?
Yeah.
That is the absolute core of a sneaker company's business. That has to be scary for them.
It is, but remember context. That huge drop is largely because they pulled all that bad footwear out of the mass market. If you look closely at the winners list, it tells you exactly where the brand wants to go.
Okay, what's winning?
Training showed really healthy growth. They specifically highlighted their new partnership with HY Rocks.
Oh, HY Rocks. That's that massive indoor fitness racing competition, right?
Yeah.
It seems to be exploding in popularity everywhere right now.
It is. It's essentially the new CrossFit, and PMA locked down the exclusivity there.
Smart move.
Very smart. Then you have performance running. Despite the overall revenue mess, they saw strong growth in running, driven primarily by a shoe called the Velocity Nitro 4.
Why is that specific shoe so important?
Because for years, serious marathon runners didn't really respect PUMA. If you were running 50 miles a week, you went to Brooks or Hoka or Saucony, you didn't buy PUMA. So gaining actual traction with the serious running crowd is a massive deal for their credibility.
Okay, so that covers the athletes. What about the fashion side?
Sports style Prime and Select grew, and this was heavily driven by the Speedcat family.
The Speed Cat. Wait, the really low-profile driving shoe? That feels like a total throwback to the early 2000s.
It absolutely is, but it is hitting the current fashion trend perfectly. The whole terrace look and those ultra-low profile sneakers are very in right now.
So the strategy actually is working in these specific pockets.
Exactly. High-end fashion sneakers and serious performance running shoes are selling well. The cheap, generic sneakers at the discount outlet mall are just gone.
Got it. Geographically speaking, where is the pain concentrated? Where are they losing the most money?
North America was the epicenter of the pain.
Makes sense.
Yeah, that is where the mass merchant addiction was the worst. So naturally, the withdrawal symptoms are the strongest there. Europe, or the EMEA region, was also down about 24% in Q4, but that was largely due to those inventory takebacks we discussed earlier.
What about China? Because in the retail world, everybody's obsessively watching the Asian market right now.
China is a fascinating case in this report. Overall wholesale declined there too, and this is a really interesting data point, their direct-to-consumer channel in China actually grew.
So Chinese consumers still want the brand. They're just shifting how they buy it. They're moving to the direct channels.
Precisely.
Well, speaking of China, we really have to talk about the elephant in the room, or I guess the dragon in the room, because right in the middle of all this financial carnage, there was a massive structural announcement in January of 2026.
The Ant-TA announcement.
Yay.
This changes absolutely everything regarding the future of Puma. On January 27th, Anta Sports agreed to acquire a 29.06% stake in Puma.
Now, for you listening who might not follow the global sportswear industry closely, who exactly is Anta?
They are a Chinese sportswear giant,
Mhm.
and they are massive. They own Fila, they own Salomon, Arc'teryx, Wilson. They are basically a giant conglomerate that specializes in acquiring and scaling premium performance brands.
So they just bought nearly 30% of Puma. I mean, legally that isn't a full takeover, but it's definitely not just some passive little investment.
No, it is a controlling stake in all but name. Anta is now a dominant shareholder. On one hand, this strongly validates Puma's reset strategy. Anta wouldn't buy into a sinking ship unless they truly believed it could float again.
Right.
But on the other hand, it puts immense pressure on Arthur Hold and the management team. Anta knows exactly how to run highly profitable premium brands. They are going to be watching this transition year like hawks.
It honestly feels a bit like a lifeboat, though. I have to imagine Puma's cash situation must have been pretty dire for the board to welcome a stake that large from an outside conglomerate.
It was dire. Let's look back at the actual cost of this reset. We already mentioned the net loss, but the cash burn was equally significant. Their free cash flow swung to a negative 530 million euros.
$500 million out the door.
Yeah. And just to keep the lights on and keep operations running during this, they had to secure bridge loans and issue promissory notes. Their net debt skyrocketed from about 120 million euros the prior year to over 1 billion euros.
Over $1 billion in debt.
Okay.
So they leveraged the company to the absolute hilt just to survive the surgery.
They really did, and they aggressively cut costs everywhere else they could. They listed about 192 million euros in what they call one-time effects.
What does that actually mean?
A lot of it was goodwill impairment, which is basically accountant speak for admitting that past business acquisitions just aren't worth what they originally thought they were, plus costs for a massive efficiency program. But the real tangible cost was human.
Job cuts.
Yes. The report confirms they reduced their workforce by approximately 1,400 corporate roles since the beginning of 2025.
1,400 people. I mean, you cut 1,400 corporate jobs. That changes the entire culture of a company overnight. That is a massive amount of institutional knowledge just walking out the door.
It is. It creates a much leaner organization, sure, but it also creates a very fearful one. And for any investors listening to this, this is why the board proposed zero dividend for 2025.
Because last year they paid out, what, 61 cents a share?
Exactly, 61 cents. Now, nothing. It's a very clear signal to the market that says, look, we need every single cent to fix this mess.
There was one other corporate shift mentioned in the sources, something involving United Legwear.
Right, that's a bit technical, but it really shows their current mindset. Back in November 2025, Puma moved from a deep partnership with United Legwear to just a standard licensing agreement.
Okay.
Because of that structural change, they had to classify that entire part of the business as discontinued operations on the balance sheet. Basically, they are entirely outsourcing the sock and legwear business rather than trying to manage it themselves as a joint venture.
So it's just another move to simplify everything and focus solely on the core, which is premium shoes and apparel.
Precisely. Cut the distractions.
Okay, so 2025 was the reset, the burn it all down year. We are now in 2026. CEO Arthur Hodold calls this the transition. So is the bleeding finally over?
No, it's not. And to their credit, management is being very transparent about that. They explicitly stated in their outlook that 2026 is not a bounce back year yet. Overall, sales are actually expected to decline again,
Still declining. By how much?
only in the low to mid single digits this time.
Okay, so the shrinking continues, it just slows down a bit.
Yes, and they fully expect to lose money again. Their operating result, their EBIT, is projected to be negative again, somewhere between minus 50 and minus 150 million euros.
Wow, that is such a tough sell for Wall Street, or, well, Frankfurt in PMA's case. Just telling investors, hey, stick with us, we're going to lose another 100 million euros this year.
It takes nerves of steel.
What is the bridge to the other side then? What are they hanging all their hopes on for this transition year?
They have identified 4 strategic pillars to get them through 2026. First is football soccer for the Americans. The Men's World Cup is coming up in 2026, and PUMA has a very deep heritage there. They absolutely need to win on the pitch.
That makes total sense. World Cup years are always a massive bonanza for jersey sales and new cleats. If you are a global sports brand and you can't win during a World Cup, you have fundamental problems.
Exactly. Second pillar is running. They plan to aggressively expand that Nitro technology platform we talked about. Third is training, heavily leveraging that HYR Rocks exclusivity to capture the gym crowd.
And a fourth?
Sports style. Continuing to use their massive archive to keep the fashion crowd happy with retro hits like the Speed Cat.
It really sounds like a back-to-basics strategy. Just stop trying to be everything to everyone at the discount mall and focus purely on soccer, running, gyms, and cool sneakers.
That is the transition in a nutshell. They are stripping away all the noise to get to the end game, and the end game is 2027. That is the magic date they have circled on the calendar.
What exactly is the promise of 2027?
That is when they are targeting a return to what they call above industry growth and healthy profits. But Arthur Hold actually threw down a massive gauntlet in his CEO statement.
What did he say?
He explicitly stated that the ultimate goal is to establish PMMA as a top 3 global sports brand.
Top 3. Okay, so obviously that's Nike and Adidas sitting at 1 and 2.
Right.
And PMA wants that third spot undisputed.
They want it bad. But right now, that third spot is an absolute dogfight. You have Lululemon, Under Armour, New Balance is surging, Hoka, On Running. It is an incredibly crowded field.
It really is.
PUMA is betting that by shrinking right now, by becoming more premium, more scarce, more desirable, they can basically leapfrog all that competition in 2027.
It is the ultimate corporate gamble. You are essentially betting that scarcity creates demand. You are betting that by telling people no today, they will beg for your product tomorrow.
And frankly, most publicly traded companies are just too scared to do this. They are total slaves to the quarterly earnings report.
Right, they have to hit the next quarter's numbers.
Exactly. They would rather heavily discount the product just to hit a short-term sales volume target, even if it destroys the brand's reputation long-term. PUMA, largely thanks to that anti-backing and a very supportive board, is actually taking the long view here. They are trading short-term volume for long-term brand equity.
So let's wrap this up for everyone listening. PUMA sacrificed all of 2025, and they are preparing to sacrifice 2026. They fired their wholesale partners, cut 1,400 jobs, took on €1 billion in debt, and basically sold 30% of the company to the Chinese just to survive, all to prove that they are still a premium brand.
It is a high-wire act. If it works, they emerge in 2027 as a leaner, highly profitable, much cooler brand that commands premium prices. If it fails well, they might just get fully absorbed by Anta.
And that is exactly the provocative thought I want to leave you with today. As you look at these numbers, you really have to ask yourself, is this painful reset setting the stage for a massive independent comeback? Or is this just the corporate equivalent of fattening up the calf before a full acquisition? Because a slimmed-down, highly profitable PUMA is a much more attractive target for Anta than a bloated one.
That is the billion-dollar question right there. We will definitely be watching the transition of 2026 very closely to see if they can actually pull the nose of this plane up before they hit the ground.
Thanks for breaking down the numbers with us today. It is
Yeah.
going to be a fascinating year for the cat.
Always a pleasure to be here.
We'll see you on the next Deep Dive.